The global economic landscape is undergoing a quiet but massive shift, and the recent official consumer price index inflation figure rising to 4.2% year-over-year is just the tip of the iceberg. While an annualized rate this high hasn't been seen since the chaotic post-pandemic price surges, the number itself isn't a surprise to anyone who buys groceries or pays rent. It merely formalizes what the average person already feels every single day. Money simply does not go as far as it used to. However, focusing solely on this headline percentage misses the much larger, far more concerning wave of economic pressure that is currently moving through the supply chain. To truly understand where the global economy is headed, one has to look at the Producer Price Index, which measures the costs businesses face when purchasing the raw goods and services needed to create consumer products. Last month, this index experienced its largest single spike in an entire decade, with the sole exception of a brief, volatile month during the absolute peak of post-pandemic inflation. This tells us that the expenses piling up behind the scenes are accelerating at an alarming rate, and those costs have to go somewhere eventually. The underlying catalysts for this wholesale price explosion are highly visible if one knows where to look. First and foremost, energy costs act as a foundational tax on the entire global economy, meaning that when fuel prices rise, that increase inevitably trickles down into the cost of every single item that requires a truck, ship, or plane to move. On top of these volatile energy markets, international trade has been thrown into chaos by persistent tariff uncertainty, leaving businesses unable to accurately forecast their long-term supply costs. At the same time, we are witnessing significant market consolidation, where smaller competitors are being swallowed up or pushed out, leaving fewer players with greater power to dictate prices. To make matters more complicated, a massive amount of capital and physical infrastructure is currently being redirected away from services that benefit ordinary citizens and local businesses, and is instead being funneled into building out colossal data centers to support the technology boom. Ultimately, the enterprises facing these compounding expenses are trapped in a corner where they must either accept lower profit margins or pass the higher prices directly down to the consumer. In the end, that decision will be made for them by the limits of human endurance, specifically, how much more financial strain the average household can physically bear before stopping spending entirely. While the current cost of living crisis is undeniably painful, a candid look at the broader economic indicators suggests that things could actually be much worse right now, which implies that a heavier blow is waiting down the line. The true danger of these stubborn inflation numbers is that they place the newly appointed leadership of the Federal Reserve in an almost impossible geopolitical and domestic predicament. Under normal economic theory, the textbook response to rising inflation is to raise interest rates, which cools down an overheating economy by making borrowing more expensive. However, executing that move today risks entirely collapsing the stock market, which is arguably the very last pillar holding up the illusion of a robust American economy. This vulnerability is particularly acute right now because the financial market is actively preparing to absorb 3 historically massive initial public offerings in the coming months, alongside a monumental corporate capital raise. If the central bank chooses to aggressively combat inflation, they risk triggering a severe market crash. If they choose to protect the market, their remaining options involve systematically sacrificing the purchasing power of the American consumer, the stability of the American worker, or the global dominance of the American dollar. Compounding this entire dilemma is a harsh, unyielding reality that no amount of financial engineering can fix. Central banks can print trillions of dollars, but they cannot print a single drop of oil. Any future energy price increases will be stacked on top of a baseline cost of living that has already forced a vast portion of the population to cut back on absolute essentials. This brings us to the core mystery of why the economy hasn't completely cracked yet under this immense pressure. The answer lies in a series of temporary buffers, or sacrificial shields, that have effectively insulated the public from the full force of these rising costs over the past year. The first major shield has been the systematic burning through of private corporate inventories. Back in early 2025, anticipating massive international trade disruptions and the implementation of aggressive new tariffs, companies embarked on an unprecedented hoarding campaign, filling their warehouses with every component part and consumer good they could get their hands on. In the first quarter of 2025 alone, American businesses injected roughly $172 billion into building up their inventories. Government gross domestic product data reveals that this was the largest single quarterly buildup of inventory outside of the immediate post-World War II pandemic recovery, stretching all the way back to the 1940s. While this strategy obviously could not be applied to perishable goods, it allowed companies to hoard massive stockpiles of manufactured goods and industrial components, creating a temporary cushion against the impending price shocks. However, this inventory hoarding strategy created a deep division within the business community, functioning as a highly effective, albeit legal, anti-competitive weapon for massive corporations. Giant big-box retailers and large-scale business-to-business suppliers possess the immense capital and sprawling distribution networks required to store a year's worth of imported goods before new trade taxes took effect. In stark contrast, local independent businesses and smaller distributors lack the warehouse space and cash flow to pull off such a maneuver, obtaining at best a few extra weeks of supply. When the tariffs were implemented, the corporate giants were able to maintain stable, competitive prices by drawing from their tax-free stockpiles, while their smaller rivals were immediately hit with a 30% tax on incoming goods. For the big players, this was a perfect opportunity to starve out the competition under the guise of the free market, since they could claim it wasn't their fault that smaller companies failed to prepare. For ordinary consumers, this corporate maneuvering provided a temporary blessing by delaying the full impact of price hikes on retail shelves. Early on, Financial institutions like Goldman Sachs estimated that companies were passing along only about 1/5 of these tariff-driven cost increases to the public. However, a year later, that figure has climbed closer to 3/4, and recent analysis from researchers at the Federal Reserve indicates that we have officially entered a phase of full pass-through, meaning the inventory cushion has officially run completely dry. To make matters even more chaotic, the legal and administrative handling of these international tariffs has turned into a bureaucratic nightmare that further punishes the vulnerable while enriching the deeply connected. When the Supreme Court struck down the largest batch of these tariffs in February, it should have provided immediate financial relief. Instead, it triggered a complex bureaucratic tug-of-war, with the White House continually seeking alternative administrative avenues to bypass the rulings and re-implement trade restrictions. Because the original round of tariffs was ultimately deemed legally unenforceable, the federal government now faces the obligation of paying back approximately $166 billion in refunds to roughly 330,000 corporate importers. It is highly naive to assume this money will ever trickle down to lower prices for everyday consumers. Instead, it has become caught in a grindingly slow, administratively hostile refund process. Large corporations can easily afford to dedicate teams of attorneys to wait out the government, but desperate small businesses, facing immediate payroll crises, simply cannot wait months or years for their cash. This desperation gave rise to a highly cynical new predatory investment industry centered around the financialization of government policy tools. Specialized investment firms began aggressively targeting struggling small businesses, offering to buy out the rights to their future, unconfirmed tariff refunds in exchange for immediate cash. Trade attorneys reported being inundated with hundreds of daily solicitations from funds offering to purchase their clients' claims for a mere 20 cents on the dollar. Many cash-strapped business owners took these abysmal deals just to keep their lights on, allowing wealthy Wall Street investors to realize staggering 400% returns on that human desperation within a matter of months once the refunds were locked in. While defenders of this practice argue that these firms took on a legitimate risk that the government might never pay the refunds, the ethics of the situation become deeply blurred when looking at the architects of these policies. It has become increasingly clear that individuals involved in designing the original tariff frameworks held direct financial interests in the very investment vehicles betting against the legal survival of those same trade policies. This blatant exploitation underscores how the modern economy favors capital over labor, but the immediate macroeconomic takeaway is clear. With private inventories depleted, businesses are now fully exposed to the raw cost of making and importing goods, which is currently climbing 1.5 times faster than the headline inflation rate. Larger companies will not absorb these tightening margins forever, and as smaller competitors are forced out, the remaining corporate monopolies will have free rein to pass these input price shocks directly to the consumer. With the private sector's inventory shield officially exhausted, the focus shifts to the second, even larger buffer that has been heavily drawn upon over the past 100 days. The United States Strategic Petroleum Reserve. This federal stockpile, consisting of an immense ocean of crude oil stored across 4 highly secure underground salt caverns, is designed to act as an emergency shock absorber for the global superpower. In theory, when international conflicts or supply chain disasters threaten to trigger catastrophic spikes in energy costs, the government can release millions of barrels of oil into the commercial market to stabilize global supply and keep domestic prices grounded. However, this emergency mechanism is finite. At the beginning of this year, the reserve held roughly 411 million barrels of oil. Following weeks of some of the most aggressive historic drawdowns ever recorded, that number has plummeted to approximately 349 million barrels, leaving the reserve sitting at less than half of its total structural capacity of 711 million barrels. This unprecedented drainage of America's energy security would be manageable if the geopolitical conflict involving Iran had been a brief, multi-week affair as initially forecasted. Instead, the crisis has dragged on for over 3 months, and despite intermittent peace negotiations, a return to regional stability remains a distant prospect. The United States has committed a staggering 172 million barrels of oil to a coordinated international emergency release program. Fulfilling this massive commitment will leave the nation's strategic reserve at its lowest level since 1982, a historical benchmark that followed the most severe global energy crisis in modern history. The terrifying distinction is that it took over 2 years of grinding global turmoil in the late 1970s and early 1980s to drain the reserve to that critical level, whereas today, the government has burned through a comparable amount of energy security in just over 100 days. Furthermore, there is a hard, physical limit to how low these reserves can go. To maintain the structural integrity of the underground salt caverns and prevent them from collapsing under the weight of the earth, an absolute minimum of 150 million barrels must remain in the caves at all times. At the current rate of depletion, the United States is roughly 10 weeks away from hitting this unyielding geological limit, at which point the final cushion protecting the global economy from a total energy price shock will completely vanish. The consequences of hitting that wall cannot be overstated, because energy costs are the hidden DNA of all consumer pricing. It is a fundamental misunderstanding to view oil prices merely through the lens of what it costs to fill up a personal car at the gas station. Virtually every tangible object in the modern economy relies entirely on diesel-powered transportation to reach its final destination. Domestic trucking associations note that commercial trucks alone haul nearly 3/4 of all freight tonnage across the continent. When looking at recent spikes in consumer pricing, one of the most volatile sectors has been commercial air travel, which is directly tied to the broader crisis in fuel distillation. The jet fuel used to power a commercial airliner and the diesel fuel that drives a freight locomotive or a semi-truck are essentially identical chemical compounds, known as middle distillates, cooked from the exact same portion of a crude oil barrel. Therefore, when the cost of flying to a vacation destination doubles, it serves as an exact warning sign for the rising cost of shipping food, clothing, and medicine across the country. According to official energy data, regular diesel costs have spiked by nearly 60% over the past year. The world's second-largest maritime shipping conglomerate, Maersk, which single-handedly controls roughly 14% of all global container trade, reported that the ongoing geopolitical conflict is adding an astronomical $500 million per month to its operational costs. The International Energy Agency has officially categorized this as the largest supply disruption in the history of the global oil market, with roughly 14 million barrels of daily production effectively locked away from the world. Once the strategic reserves of Western nations run dry, there will be no remaining barrier to prevent these staggering costs from slamming directly into the global public. There is a common, comforting narrative that because the United States has achieved the status of a net fossil fuel exporter, it is somehow immune to these international energy shocks. This is a profound misunderstanding of how globalized capitalism actually operates. Outside of the state-controlled Strategic Petroleum Reserve, virtually all the oil and natural gas extracted within domestic borders belongs to private, publicly traded corporations. These entities have no geopolitical allegiance or patriotic duty to keep domestic prices low. Their primary legal mandate is to maximize shareholder value by selling their product to the highest bidder on the global market. Because the worldwide shortage of oil is so acute, international buyers are willing to pay exorbitant premiums for fuel. Consequently, global market analysts now view domestic energy production as the supplier of last resort for the rest of the world. This dynamic hitches domestic fuel costs directly to the global crisis price, meaning that no matter how much oil is pumped out of domestic soil, local consumers will still pay a premium determined by a conflict thousands of miles away. To make matters even more difficult, energy is not the only critical resource facing severe constraints. The physical supply chain is also heavily choked by the massive tech boom. While the world is deeply preoccupied with fuel and food prices, an enormous amount of industrial machinery, raw materials, skilled labor, and governmental attention is currently being consumed by the rapid, nationwide construction of data centers. While technology companies promise that these massive server farms will eventually spark a productivity miracle that could theoretically lower costs in the distant future, the immediate impact is highly inflationary. These data center projects are placing a massive strain on foundational building blocks of the physical economy, creating severe shortages in heavy commercial vehicles, structural concrete, steel rebar, and industrial electrical equipment. The most acute bottleneck in the entire global infrastructure network right now is the availability of heavy-duty electrical transformers. These vital metal units can either be deployed to stabilize local electrical grids and power manufacturing plants, which increases the supply of real-world goods, or they can sit in corporate warehouses waiting for a tech giant's artificial intelligence network to come online. Because the technology sector is flush with venture capital and corporate cash, they can easily outbid local utility companies, leaving vital infrastructure components sitting idle in tech warehouses. This massive capital imbalance means that the average citizen is footing the bill for the tech boom through their monthly utility invoices, even if there isn't a single data center located in their town. Local utility companies are being forced to pay exorbitant prices just to secure the basic equipment needed to perform routine maintenance on the electrical grid. Utilities across the country report that industrial transformers now cost 4 to 6 times more than they did just a few years ago, with order backlogs and waiting lists stretching out to 4 long years. These massive capital expenditures are automatically passed along to residential households through higher utility rates. A similar crisis is unfolding within the skilled labor market, where data center developers are paying commercial electricians an astonishing 32% wage premium over traditional construction projects. In primary tech hubs like Northern Virginia and Texas, specialized industrial electricians are commanding annual salaries of up to $280,000. While this is an incredible financial windfall for these tradespeople, it leaves residential home builders and local factory operators completely unable to compete for labor. The nation is currently facing a systemic shortage of roughly 300,000 qualified electricians, and homebuilders report that this intense competition for labor is causing massive delays in housing construction, which ultimately drives the price of real estate even higher for everyday families. When examining potential solutions to this compounding economic crisis, the most troubling reality is that the traditional cures are poised to inflict just as much financial pain as the disease itself. The most direct path to stabilization would involve resolving international conflicts and establishing absolute legal clarity on trade tariffs, but international diplomacy has repeatedly stalled. Even when historic peace treaties are signed, they often come with massive economic concessions, and critical trade routes remain heavily taxed under alternative names like environmental fees, maintaining the exact same inflationary pressure on shipping costs. This leaves the entire weight of the crisis falling squarely on the shoulders of the Federal Reserve, an institution that possesses only 2 primary, blunt instruments for economic engineering: pulling cash out of public circulation or raising interest rates. Both options carry immense risks of systemic collapse. If the central bank raises interest rates further, they create a scenario where institutional investors can secure high, guaranteed returns by simply parking their wealth in ultra-safe government bonds. This tempts capital to abandon an already dangerously overvalued stock market, as investors question why they should risk their fortunes in a volatile corporate bubble when a 30-year U.S. Treasury note will pay them an entirely risk-free return of over 5%, a level not seen since the run-up to the 2007 financial crash. This potential capital flight from the stock market is exceptionally dangerous right now because the corporate landscape is facing an unprecedented, multi-billion-dollar demand for liquidity. The market is currently trying to digest three of the largest initial public offerings in human history, alongside a massive capital raise from the world's dominant tech monopolies. One major aerospace firm recently went public, raising $75 billion at a staggering $1.75 trillion valuation, marking the largest IPO on record. Hot on its heels, a dominant artificial intelligence startup filed confidentially for its own public listing at a valuation exceeding $850 billion, while a chief rival filed for its own listing at over $1 trillion. Concurrently, a legacy tech conglomerate announced an unprecedented $80 billion equity raise, a defensive move typically avoided by mature megacap corporations, forced by the desperate need to fund its capital-intensive data center expansions. All of these massive corporate entities are holding their hands out for cash at the exact same moment the federal government is issuing massive amounts of high-yield debt to fund its own deficit. If the central bank chooses to raise rates or drain liquidity from the system to fight inflation, there will simply not be enough cash to satisfy these competing forces, which explains why the stock market reacts with absolute panic to any sign of persistent inflation. This dynamic has created a highly distorted, perverse environment where the financial markets are now actively terrified of positive economic news, particularly strong employment data. When recent payroll reports showed that job creation came in at nearly double the consensus expectations of mainstream economic forecasters, both the stock and bond markets experienced an immediate, sharp sell-off. In a healthy, traditional economy, strong job growth is celebrated because it indicates that businesses are confident enough to expand and that citizens have disposable income to spend. Today, however, corporate valuations have been stretched so far into the future that it would require decades of flawless consumer spending just to justify current stock prices, making real-world economic growth largely irrelevant to Wall Street. Instead, strong employment data is viewed as a threat because it strips away the primary excuse the central bank could use to lower interest rates. The Federal Reserve operates under a strict mandate to balance stable prices with maximum employment, so if the official data asserts that everyone has a job while inflation is rising, the central bank has no choice but to push interest rates higher. While some might argue that a stock market correction is a harmless event that only impacts the ultra-wealthy, the modern economy has become so top-heavy that a market collapse would quickly trigger a catastrophic broader recession. Central bank data shows that the wealthiest 10% of households own an astonishing 87% of all corporate equities, with the top 1% alone controlling nearly half of that wealth. However, these same wealthy households have become the primary engine driving aggregate consumer demand, with the top 10% of earners now accounting for nearly half of all consumer spending in the country, the highest concentration of spending power recorded since 1989. This creates a powerful wealth effect. When the stock market is booming, these wealthy individuals feel incredibly rich, leading them to spend lavishly on luxury goods, high-end services, and corporate capital projects, which creates jobs and economic momentum for the remaining 90% of the population. If the stock market experiences a severe downward correction, this affluent class will instantly halt their discretionary spending, freezing the primary growth engine of the economy and triggering a massive employment crisis that would devastate the working class far worse than the current cost of living crisis. Conversely, if the political and financial leadership decides to avoid a market crash by simply letting inflation run rampant, they risk permanently destroying the global status of the United States dollar. The dollar's position as the world's undisputed reserve currency is the ultimate geopolitical superpower, allowing the nation to run massive, unprecedented deficits and import cheap goods from every corner of the globe by paying in a currency that everyone is forced to accept. However, this global trust is fraying, and the dollar's share of international foreign exchange reserves has quietly degraded to its lowest level in 3 decades of official records. Earlier this year, the global dollar index broke down to critical lows, reversing the temporary gains it achieved during the initial flight to safety at the start of the international war. If persistent inflation erodes the purchasing power of the dollar, international central banks will accelerate their shift away from American currency, permanently undermining the cheap credit and easy capital that the domestic economy has relied upon for the past 80 years. While a weaker dollar makes domestic exports cheaper on the world stage, that mathematical benefit is completely wiped out when the nation's primary imports, like energy and raw components, become drastically more expensive, exacerbating the price shocks on local store shelves. Ultimately, this entire crisis exposes a systemic, structural failure in how the global superpower manages its wealth and its obligations. The total national debt is currently rapidly closing in on a mind-boggling $40 trillion, having expanded by an astronomical $3 trillion over the past year alone. To put that into perspective, the actual productive economy underneath that mountain of debt grew by less than $2 trillion over the exact same period, meaning the government is accumulating debt far faster than the country can grow. The interest payments required just to service this debt are now consuming over $1 trillion annually, creating a compounding trap where the government must issue more debt just to pay the interest on its past borrowing. The nation is attempting to carry this crushing financial burden while simultaneously fracturing its own supply chains, alienating international trading partners, and allowing its critical infrastructure and energy security to be depleted for short-term relief. While minor glimmers of hope exist in isolated sectors, such as automobile manufacturing where major companies have inadvertently driven down prices by mismanaging their own inventory pipelines, these anomalies do nothing to solve the systemic crisis. The global economy is rapidly running out of the physical buffers and financial illusions that have kept it afloat, and the coming months will force a reckoning that no amount of monetary printing can delay.